Nani of Max Trading Systems. He's going to talk to us about how to build a trend-following strategy. And Eusebio is well-known and highly respected with 38 years of experience in Forex, futures, stocks, and options, plus 15 years in the banking industry. Eusebio has not had a losing day of trading in the past 4 years, and his record of profit-taking and insistence on strict risk management have brought him wide recognition as a world-class trader. Welcome, Eusebio. I appreciate you coming in, and I'm going to make you my presenter.
Thank you very much, Sherry. Thank you for your amazing support. So,
thank you. Take it away.
Okay. Thank you very much. Welcome, everyone, to this event. Just let me give you a few words about who I am, but Sherry has already presented who I am. I am indeed one of the Max instructor in the Max Trading System, and I am a past software engineer. I was a services manager in the IT industry, and for around 28 years, and during the last 15 years of my career, I have had the privilege to work with some important banks in Europe, and this has given me the opportunity to meet some traders from whom I have learned a lot. But I am interested in trading and investing in different markets for many more years, so around 30 years now, more than 30 years. So I have traded in the stock market, the options market, the futures market, and presently I'm almost trading exclusively in the Forex market, in the currency market. So we have two other partners in the group, so Craig and Chris, who were in fact the partners of the designer of the Max Trading System, Dr. James Pruitt, known as Tiger. So that being said, let's start with the content of my today presentation. Today, because we are trend following traders with the Max, I will define I will explain how to define a trading method or a trend trading method. I will first of all describe the different steps we have to cover, and then I will go progressively in each of these steps, and then I will make a quick presentation of our offer. So when we consider a trading process, we have always to consider what are the essential pillars of the trading process. And for me, there are 5 pillars. First of all, and obviously, we need a trading method. We need a trading system. We need also a trade risk management and a money management in order to control the risk whenever we take a trade, and in order to grow in a safe way our trading account. We need also to have a good understanding of the global context, because the global context contains in reality all the driving factors of the market we are considering. Examples of global context elements are the decision of the central banks, their monetary policy and their interest rates decision. But we have also all the economical news releases, like for example a few days ago the CPI. We have also the geopoliticals, which may drive the market, which may influence in somewhat the market, and we have known we are knowing for the moment a very important one, which is the coronavirus with the worldwide epidemic. We have also to consider the psychological aspect of trading, which is a point which must never be neglected and unfortunately often neglected by many traders. And then another point which is also very often neglected by many traders is the organization. By organization, I mean what are the steps we have to go through during our trading session, and for that it's the preparation of the trading session, how to monitor and how to execute the trades, how to update the informations several times during the day, and how to make a debriefing of our trading session in order to control if we have followed correctly all the rules and the concept of our trading approach. And there are other very important points we have also to consider if we want to make of our trading activity a professional activity. But today I'm going to focus on the first point first. A few weeks ago, in my previous presentation, I have described how we proceed for the global context analysis. Today I will focus on the trading method itself. And so, in order to define a trend trading system, I think that we need to have at least the 5 following steps. First of all, we have to define what are the trends we want to trade. I have seen very few trading approaches defining how to consider a trend or what a trend is. And inside a trend, we have to define also the movement we want to trade. Then, once we have defined what a trend may be, we have to define how such a trend may start and how such a movement inside a trend may start. And we will consider the start of a trend or a movement as what we call an entry setup. They will be, in fact, specific price action patterns. Once we have an entry setup, this does not mean we have a trade. We still have to validate that the entry setup pattern is valid. And we will make several types of validations. We will consider the technical analysis aspect of the setup. This means, is the pattern a correct pattern? We will have to consider if our entry setup is in agreement with our global context analysis. We will have to consider the risk we associate to the trade. And if we day trade in a small time frame, for example, the 5-minute time frame, the 15-minute time frame, the 1-hour time frame, we will have also to consider other conditions linked to some specific critical time period during the day. There are some times during the day we have to pay extremely attention when day trading. Then when all these conditions are fulfilled, then we have the trade and we can execute the trade. Once we are in a trade, we will have to define how to handle the trade in order to progressively reduce the risk we are assuming on the trade, and at some point to even cancel completely the risk we have on that trade in order to have a guaranteed profitable trade. Once we achieve that point in our trade, then we can consider to optimize the profit we can extract from that trade. And of course, we will have to define, in order to close the trade, we will have to define how or when a trend or the movement we are trading inside that trend will possibly exhaust or reverse. And so I'm going now to go a little more in details in each of these steps, and I will illustrate with examples. So how to define a trend trading method. Of course, the first point is to define what a trend is. And there are several known techniques to define a trend. A well-known technique is to consider that when we are, for example, in an uptrend, we have to pinpoint higher highs and higher lows. When we are in a downtrend, we have to pinpoint lower lows, lower highs. A second method is using one or several moving averages, and the direction of these moving averages will give the direction of the trend. And a moving average is an indicator, of course, but we can also use other tools, other indicators. Now, of course, one point some traders can exhibit is using a technical indicator is not necessarily appropriate, because technical indicators are derived from the price action itself, are calculated from the price, and they are always lagging. That's true that an indicator is always lagging, more or less, but that's not the point. In fact, the point is how do we use that indicator in relationship with the price. We have to exploit the relationship between the behavior of the price and the behavior of the indicator itself. So let's see on the charts these different types of definition. In this case, we have the price going upward. The pair in itself is not important, the time frame is not important, and along that up movement, we can start with a low, then we have a high, then we have a higher low, we have a higher high, another higher low, another higher high, another higher low, and so on, until this pattern of higher highs, higher lows is broken with a lower low and a lower high. When we have such a violation of the pattern for the uptrend, does this mean that the trend is reversing? Not necessarily. We may have what is called a complex correction or a complex pullback before possibly the trend resumes with another higher high and then possibly a higher low. So this is the first example how we can define a trend. Another way, as I have said, is to use one or several moving averages. Many trading system uses, for example, 3 moving averages, and the direction of these moving averages will give the direction of the trend with very specific behavior between the price and these moving averages. As long as the price will go, for example, like in this case, upward, the price will make regularly some pullbacks. And some of these pullbacks will come close to one of the moving averages, and sometimes by the pip. It may be the short-term moving average, but it may be the long-term moving average. And sometimes the price can, of course, cross the moving average before resuming the trend. But this is not the approach, the 2 approaches I have just described we will use in our max trading system. We use, in fact, another type of analysis considering what is happening in a higher time frames. And in this example, so we have the same pair, the euro-US dollar, and on the chart itself, we have a more sophisticated type of moving average, which is very close to the price action, in order to define the possible movement inside the trend. And the trend itself is indicated by that line in green and red at the bottom of the screen. We call the slow bias or the long-term bias, which will indicate, in fact, an uptrend when the line is green and a downtrend when the line is red. And so you can see in the yellow rectangle an uptrend because the slow bias was green, and inside that trend we have 3 movements we can possibly trade. And similarly, if we consider a downtrend. So everything can be used in a symmetrical order to define so the downtrend and the down movement inside this downtrend. Now, when we have defined a trend, we will have, of course, to define when a trend or a movement inside that trend may start. And I have said that we use specific price pattern we call entry setup. And these setup are high probability entry setup. When I say by high probability entry setup, this means that the success rate of these price patterns is at least 70 to 75%. So this means that whenever we see such an entry pattern, we have a probability of 70 to 75% that the trend following that entry setup will be a profitable trade. And this is when we ignore the global context. When we take into account the global context, then the winning rate will jump to 90 and 95%, which is a very, very high winning rate. And so let's see that on an example. So I still take the euro-US dollar. And on this example, I have noted 3 types of entry setup. Whenever a trend starts, indicated by a change in color in our slow bias indicator, we will have to pinpoint one of the possible entry pattern we can observe at the beginning of a new trend. And in the max, we have defined 3 types of entry setup. This is an example of such an entry setup, which is called a BO-MO. MO means a momentum entry, and BO means breakout. So this bar, this candle shown by this first green dashed vertical line is called a breakout MO, because in fact we can see that we have some kind of breakout of a small consolidation zone mode. And we have to define what is a consolidation zone, of course. Later in the trend, we have some other possible entry setups, and we have in fact 2 types of entry setups. An entry setup which corresponds to a resumption of the trend, following generally a pullback and sometimes a deep pullback, and this kind of setup is called a REMO, for resumption momentum entry. We may have other entry setup, of course. We have two of them and some variations like breakout entry setups. You can see that later the trend has reversed to the downside because the slow bears has turned to red and then resumed to the upside when the slow bears turned again green. And so we have another entry setup at the beginning of this new uptrend, which is called a safe and perfect Mo. It is one of our three possible entry setup we have at the beginning of a new trend. The third one being called a BTMO or breakthrough Mo, and depending the type of the setup depends on the type of behavior the price has in relationship with our moving average line, which by the way we call the ETF lines. So once we have defined or once we have pinpointed such an entry setup, this does not mean that we have a trade. We still have to validate that entry setup and so that trade with all the conditions I have already previously mentioned. And so let's recap these conditions. We have the technical analysis validation, which is made by pinpointing the entry setups. We have to take into account the global context. Do we trade in agreement with the global context? And just to remind you what is the global context for those of you who have participated to this presentation a few weeks ago. So with the global context, we are able to tell or to explain if a currency is strong or weak, if a currency is gaining strength or if the currency is losing strength. And so whenever we know the direction and the strength of each currency, we can define the direction of a pair we want to trade. For example, for the euro-US dollar, if the euro is strong and the US dollar is weak due to the context analysis, then we can deduce that we have to favor the long trade on the euro-US dollar. Then we will have to define the risk we associate to that trade, and then we will have to pay attention to other conditions if we day trade. And let's illustrate that on the next slide. So here. So let's come back to our breakout Mo entry setup. So first of all, we have some technical validations. Among these technical validations, so the pattern of the setup must be correct, of course. Then we can use a technical indicator just to confirm that the price is gaining some momentum. The indicator I'm showing here is called the stochastic of the RSI, which is a double indicator, the stochastic indicator applied to the RSI indicator. And we can say that in this case, when the setup bar closes, the stoch RSI is going upward, which indicates that the momentum is increasing to the upside. And so on the technical point of view, we have a valid setup. But this is not enough. Is this setup in agreement with the context? The analysis of that day, which was the 18th of May, by the way, it was yesterday, the global context for the euro-US dollar was going long for the euro-US dollar. And so this is an upward setup, it is a long setup, so this setup is validated with the global context. We are in agreement with the global context. Then we have to define the risk with that trade. The risk is defined on two levels. First of all, we have the trade risk, and the trade risk can be explained in terms of pips. For example, here we've placed our stop loss. We always place a stop loss in order to control the maximum loss we can face in a trade. And so in this case, the trade risk is 12 pips. But of course, when we say that the trade risk is 12 pips is not enough, because the risk which is much more important than the trade risk is the financial risk. We can have a trade risk of 12 pips, but we will have a different trade result whether we trade one standard lot or one micro lot. The difference of size between the two examples I have just given is 100. And so on a financial point of view, so the risk may be seen completely differently. And so a good rule of thumb will be, so if we have a good context, we can assume a risk of 2% of our trading account on that trade. And by associating the financial risk we take on the trade and the trade risk in pips, we can exactly calculate the trade size of the trade we have to take in order to never exceed the financial risk we have chosen should the trade turns into a losing trade and hits our stop loss. So now, once we have the global context and the financial risk associated, we still have to pay attention to some critical element, because when we trade in a small time frame, not all the moments along the day are equal. On this chart, I'm illustrating some of these points. For example, with these orange dotted vertical lines, I always represent on my chart the different market or the different session open and close. We have the Frankfurt open. During the Asian session, of course, we have the Tokyo open, but it is not shown on this example. We have the London open. We have the US open on this vertical line, and we have the Wall Street open, because the Wall Street open has always an influence in the Forex market. And later we will have the Frankfurt close, the London close, and the New York or US close. In yellow line, you see also the beginning and the end of the lunchtime period during the European session or the London session. And then a very, very important line, which is this red vertical line, which represents an economic news release. In this case, it was a news on the euro. And so this news can impact, of course, the euro-US dollar pair. And the news was the flash GDP quarter over quarter and the trade balance. The flash GDP quarter over quarter has been unchanged, so no surprise. And the trade balance has been negative, in fact, worse than the trade balance of the previous months. And we will see the implication of such kind of news. So there has been such disappointment when these two news releases have been released. So once we are aware of these elements, in terms of news releases, for example, we can take the trade provided we are not facing too close the news release. And we have a very specific and strict rules which tell that if the entry setup appears during the last 1 hour before a news release, we have to skip that trade because we don't have time enough for the price to develop an interesting movement to trade. If we have more than 1 hour, then we can safely take the trade. But once we are in a trade, when we are approaching the news release, at some point we will have to close the trade in order to avoid some very speculative movement when the news is released. We never know in advance what is the result of the news release. We may have no surprise, we may have a big surprise, but the surprise may be a positive surprise or a negative surprise. And in the case of a negative surprise, we can see a very fast spike to the downside, so hitting our stop loss, and we are not sure that the close of the trade on the stop loss will be executed on the stop loss price. Sometimes we may have important gaps, and so we never want to be trapped in such a situation. So we always close the trade before the news release. And after that, depending on the nature of the news release, we have to make an update of our global context to see if the context has changed or if the market sentiment has changed. And if this is the case, we can take other trades again in agreement with the new global context or market sentiment. Now, once we are in a trade, so we will have to handle that trade. By the way, in this example, I have mentioned that later on this blue candle, we had a safe, on this blue candle here, we had a safe and perfect move because a new uptrend was starting. But when we observe our indicator, the pattern the indicator is showing represent a counter indication. And so there are lots of techniques to exploit technical indicators, but when we use them in a very specific way, we can define when they give counter indications telling us that this trade or this setup, if we take the corresponding trade, will become a very risky trade. And so it's the choice of the trader to decide to take that trade or to skip that trade. And if the trader decides to take that trade, it may be a trade with a different risk. It may be a risk of, for example, 1% or 0.5% or whatever, a smaller risk. So now that we have validated our entry setup, let's consider how to handle the trade. And on the next page, so I describe how we handle the trade. So in order to progressively reduce or cancel the trade. And to do that, we consider at some point to bank some profit. Whenever the price moves in our favor, we can consider to bank some profit by closing a portion of the trade and leaving the other portion as a running trade until a next decision must be taken. And we will also adjust the stop loss. And so we have to define rules how to adjust the stop loss. And so let's consider now the next slide illustrating how we handle the trade. Among the exit technique we have several types. We have exit technique based on technical indicators. We have exit technique based on pure price action. We have exit techniques combining price action and specific indicators on our main chart. We have also exit techniques based on critical time period like a news release. And we have exit techniques also taking into account what we call the movement invalidation or the trend reversal. And so let me explain here two types of exit techniques we can consider and you can apply, by the way, in your own trading system, at least if you are trading trends, in fact. And so in this case, you can see on the first magenta vertical line, pinpointing a specific red candle, that the price is making two successive higher highs, while the stochastic of the RSI, I will call it the Sto RSI, is making just two lower highs. This is what we call a divergence between the price and the indicator. Now, a technical indicator never predicts what the price will do. We use our exit technique in such a way to identify when a risk appears in our trade and this risk becomes too much important. So it's a way to quantify the risk when the price is retracing. Indeed, while the price is moving in our favor, we are making a potential profit. But once the price begins to retrace, begin to make a pullback, a portion of the potential profit we had is disappearing. And the problem is we never know how deep the pullback may be. It may be a small pullback, but it may be a deep pullback, or it can be a trend reversal. And so we need a way to measure when that pullback becomes too much important in such a way to force us to take a decision to reduce that risk and so to close partially our trade. And so once we have pinpointed an exit setup, we define an exit level, and if the price hits that exit level, we close a portion of the trade. It can be, for example, as we do in the max trading system, 1/2 of our initial trade size. In this example, the price has missed to hit the stop loss, which is a good point because at this point we don't need to make an exit. By the way, such a partial exit is called an MX, MX meaning momentum exit. And so we keep our entire trade to run until the next exit setup. On the next exit setup, it is the next red candle. We have again a divergence between the price making two higher highs and the Sto RSI making two lower highs. So we define an exit level, and on the next candle, the price this time make a pullback deep enough to hit our exit level, forcing us to close half of our trade. So we make our effective MX, and this MX in the 5-minute time frame catches a profit of 15 pips. At the same time, we adjust our stop loss along the trade, and for that we use a specific indicator which represent or which represent a combination of the momentum and of the volatility of the price. There are many indicators which condense the momentum and the volatility of the price, so anyone can make the job, and so we use one of them, and we adjust our stop loss along that blue line. It is a blue line below the price when we are in an uptrend, and it is a pink line when we are above the price in a downtrend. So we adjust our stop loss a few pips below that line in order to avoid some spikes the price can sometimes do, like in this situation, for example, and we want to avoid this kind of too early exit. And so once we have made our MX, we have to consider how to handle the rest of the trade. And for that, we have two options. The first option is we wait for the next exit setup. We define our exit level, and if the price follows through, by the way, this exit was also divergence. If the price follows through, we close the second portion of the trade, and we call that close an XXX, a complete close of the trade. This is the first possibility. The second possibility, and the choice is up to the trader, is to stay in the trade as long as the price does not reach the stop loss, and as long as the price moves upward, we continue to adjust the stop loss. And so we stay in the trade until we are forced to close the trade, because we have exit setups describing when we have to necessarily make a complete exit. And here we are facing the news release. And our rule is when we are facing the news release, in the last 15 to 30 minutes before the trade, we close the trade. And in fact, the trade will be closed, as we will see just in a moment. But the point here, when I have said our aim is to reduce the risk, or sometimes to get a guaranteed profitable trade, let's analyze the point here at the MX. When we make the MX, we catch a 15 pips profit on that portion of the trade, and we adjust the stop loss on this point. And we can see that with this point, for the rest of the trade, the stop loss is above our entry level. We are even making a small profit. We are locking a small profit even on the second half of the trade. So this means that at this point, we have not only a risk-free trade, but we have also a guaranteed profit. And this is great because when we achieve that situation of a guaranteed profit, we can try to stay in the trade as much as possible, as long as the trend stays valid. And this is what we can do. So we have to define after that when the trend possibly exhaust or reverse, or if we have a special event, which in this case was the news release. And in this case, indeed, we have 15 minutes before the news release, we close the trade, we close the second portion of the trade, catching an additional 47 pips, which adds to the first 15 pips to give a total of 62 pips of profit, which, because we have a stop loss of 12 pips, oh, I have a small typo here, sorry for that, represent a result of 2.58 reward to risk ratio. So this represents a plus 2.58 R. I like to use the Von Tarp notation, and because the risk was 2%, this represents a profit on the account of 5.17%. You can also observe that this XXX comes at the moment when the price reaches that blue dashed horizontal line, which is what we call a max price level. And a max price level may be a resistance or a support level. It may be a supply or a demand level we establish every week. And so this level has been established last week, last Saturday. And we can see how the price has reacted when it has reached that level. The price began to range around that level, making a small pullback during the lunchtime period, and has failed to go significantly higher than this level after the US Open. Now, a line is never a straight line. When we indicate such a line on our chart, in fact, we have to interpret it as an area, a zone, which represents a zone of, in this case, perhaps a supply demand, or a resistance level, whatever you want to call it. And so this is the process we use to handle the trade until its completion, focusing first of all on the trade risk management. And you can see that by adjusting regularly our stop loss along that blue line, we progressively lock more and more profit. So in a very safe way, because we had achieved that safety on the first MX. Now let me show you an example with the same pair in a downtrend. Similarly, we have at the beginning of a new downtrend, because the slow bias has turned from green to red. So we have here the pattern of a safe and perfect move. We associate our stop loss. For the stop loss, it's a coincidence that we have the same stop loss as the previous example, 12 pips. It's just a coincidence. So, and then the first exit setup which trigger, it's here this one. And this is another exit technique you can use. This candle is a long bar. It is a bar we call a long bar. And a long bar is defined in the following way. A long bar has always a length. And the length or a size is defined from its open or its high to the low. So it's the distance between the high and the low. And its length must be twice or more the average length of the previous bars. We have rules, of course, to define what are the previous bar. In fact, we have to consider the movement preceding the long bar, and the movement must contain at least two successive bars in the same color, whatever the color. It may be a pullback, it may be a movement in the direction of the trend. And so it was a long bar, and when we have a long bar, note that it is a long bar in favor of the trade. And a long bar is always a nice opportunity to bank a profit, because 2 out of 3 times, at least in the Forex, a long bar is followed by a pullback, and often by a deep pullback, and sometimes a trend reversal. And so it's always a nice opportunity to bank some profit. How do we define our profit taking? In this case, from the low of the bar, we define an exit level at a distance corresponding to a portion of the length of the long bar. That portion may be 1/4, it may be 1/3, it may be half of the size of the long bar. Personally, I choose 1/3 of the length of the bar. And so I have defined that MX level. If the price follows through, making its pullback and hit that level, we make our MX, which was the case. And in this case, the profit caught by that MX has been 26 pips. And in the meantime, we adjust the stop loss to reduce the risk on the trade. And you can see that with the last stop loss adjustment, so in this area, the second half of the trade is already locking some profit. So we are again in a guaranteed profitable trade. And this will happen very, very often if we follow that process. And then later on, the price make another long bar. You can see that this red candle crosses another max price levels without making any pullback. But then we have another max price level or support level when the price bounces off from that level, giving a nice opportunity when the trend begins to reverse also, gives a nice opportunity to close definitively the trade, so to close the second half portion of the trade, banking another 33 pips of profit. By the way, should we have waited this blue candle to close, this candle would have been, due to the trend reversal, an entry setup to go long, whether we take that long trade or not. And so we can say that in this case, by the way, the global context was short. The risk which has been taken was again a 2% risk. And in this case, 59 pips of profit, 59 pips of profit with a stop loss of 12 pips represent a reward to risk ratio of plus 2.46 R or 4.92% with a risk of 2%. And so you can see that this kind of trade, when we take the trade always in agreement with the global context, will give very, very safe trade. Of course, sometimes we can miss a nice movement. So here, for example, this up movement, but this movement was not in agreement with the context. So we can simply ignore that movement and wait for the trend to resume. But then we were facing a news release. So there were, before the Wall Street opened, there was no other trade available for that pair and that day. And so this is how we define, in fact, our trading process. You know the quote, plan the trade and trade the plan. But what does it mean, in fact? And in fact, defining how to consider a trend, defining the movement we want to trade, defining how to identify an entry setup, defining how to validate an entry setup, defining how to handle the trade, and defining how to exit a trade, in fact, is part of the plan. Plan the trade means to define all these conditions. And then you have just to execute your plan. Executing the plan or trading the plan means simply following the process we have just defined. And so it's essential to define a clear trading process. Remember the 5 pillars I have mentioned earlier in order to become profitable. And so what I have presented here for the way to define a trend following system is just one aspect of the trading activity, and in that trading process there are many more details we can explain, we can teach in our courses. We have 4 courses, and in our courses, so we always insist on gaining confidence in the skills the trader must develop, and we do that by mentoring the student, by grading the homework we require from our students, and by organizing some workshops and free workshops for our members. So every Saturday, for example, we have a practice session with our member. And so for that, I have just a few minutes to present our offers here. So we have 4 courses, but the 2 main courses, which are the courses we present today, so are the standard course and the primer course. What I have illustrated with these 2 examples is what we can do with the Max Primer course, which is the a summary of our flagship course, which is the standard course, so a simplification of the training. But the standard course goes way further, taking into account, for example, a scaling technique, how we can progressively add to our trade in order to build a larger position, in order to get or to extract a way larger profit from the trend we are trading. So these 2 courses will start very soon in next June, at the beginning of June. The Max Primer is made of 2 classes, of 2 sessions, plus a bonus session. We teach the basic entries and the basic exit. It is profitable. It takes a little more time, and it is, of course, associated with a simple risk trade risk management and money management. The standard course contains 7 sessions plus a bonus session with many more entry setups and exit technique. It is extremely profitable with the acceleration technique we call the scaling technique. It is comprehensive but simple, and it contains a simple but comprehensive trade risk management and risk management. And so you can enroll today if you want. Here are the 2 links to enroll in one or the other course. And for the participant today, we have a nice discount so to propose. If you want to have more information about what we are doing with the Max, feel free to contact us. So we have an email address, support@maxtradingsystem.com, but we have also a Skype, so you can contact us at our Skype address, which is Max Trading System. So we have also other services with a small monthly fee. We provide the price levels and the bias alert, which in fact represent the global context analysis result. And here, so you have the link if you are interested to subscribe to these information. So, and now I am open to your questions if you have any questions. Mandrip asked, do you sell our indicator? No, we do not sell our indicator. The indicators are available with the course. So every student who enroll in a course will receive our indicators and our templates. So we have our templates and indicators for MetaTrader, MetaTrader 4, and for NinjaTrader. Monthly fee, yeah, we have monthly fee, not for the course. The course is a 1 lifetime price, but we have a monthly fee. I think that for the levels and the bias, which is a bundle, I think that the monthly fee is, if I'm not wrong, $79 per month, I think. But you can contact Craig at Max Trading System, so if you want to have more information. What is the slow buyer indicator? No, it is not a slow buyer, it is a slow bias. B-I-A-S. So it is an indicator which represent, let's go back to the screen, which represent what is happening in a higher time frame. For example, when we trade in the 5-minute time frame, this slow bias indicator, we call also the companion indicator, is showing what the trend is doing in a 30-minute time frame. So in a time frame 4 to 6 times higher. And of course, in the course, we explain how this indicator is built. Do I have to go through the course to subscribe to the monthly program? No, there is no need, because these informations, like the max price levels and the global context bias, are valid for any trading system, and so you can subscribe to this product without enrolling in the course, indeed. So if I use TradingView chart, this indicator can be used. You cannot use them directly on TradingView, but you can build these indicators in TradingView. If it is the case, we will give you the source code of these indicators in such a way that you can rebuild them or recode them in TradingView. But many of them are available in TradingView. For example, we are using some moving averages. The Stochastic RSI, I think, is in TradingView. We are using also the Bollinger Bands, which are available in TradingView. There are just 1 or 2 indicators which must be recorded. But we can help you for that. Okay. Any other questions? Is there ongoing support available after the course? Yeah, of course. When you have completed the course, you are a part of the Max community. You have access to our forum. You have access to our practice session for life with no charge. And so we always give support, so you can always contact us in case of need of clarifications about some points of the methodology. You can always submit your chart, your trade, in order for us to check if your trade has been made correctly or not. So you will get the help you will ask. Okay, I think I've answered all the questions. So Sherry, I return the mic back to you. So thank you very much for your participation.
Thank you for being with us. That's a great presentation. Folks, I put the links, or the link that takes you to the links that Eusebio shared in the chat. So guys, feel free and definitely take advantage of that offer.